This is your Wall Street wake-up call. The rally is on in stocks thanks to the Federal Reserve holding interest rates steady yesterday. Michael Ingram joins me now. He's a market strategist with BGC Partners in London. So, Michael, here we are again. The markets weren't pricing in a hike, but, people said, oh, the Fed didn't prep the markets for a hike. But the language in the statement yesterday and Janet Yellen's Jackson Hole, Wyoming speech last month had the same line, saying the case for a rate hike has strengthened. So why didn't they go yesterday?
Well, I think it's quite simple, Scott. The market doesn't believe her. So it may indeed be one and done for 2016 as it was for 2015. But, the longer-term prognosis from the Fed, which is reflected in the dot plot, is that long-term interest rate expectations have once again shifted down. Of course, so has growth. They've already taken out one rate hike out of 2017. We're down from 3 to 2. But, of course, we've got to take that in the context of we thought we were going to get 4. This year, we're going to end up with 1. So the market's feeling quite vindicated. They're saying, well, look, we don't believe a word that the Fed says. We basically think we're going to have free money forever. And no matter what they say, they are eventually going to come round to their way of thinking. And that's why we're off to the races again with gains across the board and, tellingly, bond markets also rallying at the long end.
Well, isn't the Fed's lost credibility the Fed's fault? I mean, not to beat up on the Fed, but you said it. We were going into this year thinking we were going to get 4 rate hikes, and here we are 9 months into the year, and we've got nothing. So, what's to say more sluggish data doesn't come out? We had nice job gains over the summer. Did the Fed miss another opportunity? You're not going to find the ideal time to raise rates ever.
Yeah, I was thinking about running the headline, the Fed loses the dot plot. Credibility is out the window, forward guidance dead and buried. And if you want to have a glimpse of the future, you only have to look at the Bank of Japan, which is, if you like, that much closer to the monetary frontier, where they're now talking about yield curve control. So, it's a brave new world for monetary policy.
I don't know how that's going to work.
Well, your guess is as good as mine, Scott. One of the phrases that Janet Yellen mentioned in her press conference yesterday evening, which I thought was quite interesting, and she's mentioned this 2 or 3 times. She said, we were struggling to understand each other's point of view, and of course, to some extent, that's been reflected in the 3 votes against keeping rates on hold, including, somewhat bizarrely from Eric Rosengrad, but it really trying to tell you that we are in uncharted territory in terms of the global economy, in terms of monetary policy's impact on that, and basically, I think the bottom line is their models don't work, and they haven't come up with a substitute for them. But I guess this dynamic has been in place for years, but we are that much closer to the end game now. But in the meantime, risk assets, markets, party on, dude.
Well, party on, dude. How much longer will the party last? Does it go until December, when that's sort of the next month that everyone thinks the Fed is going to move?
Yeah, maybe U.S. presidential elections in the meantime might spoil the party, and over here in Europe, you have got this referendum in Italy coming up in October, which could also be a speed bump. But yeah, I think that last year, we get this rate hike in place, although the market's still only thinking about maybe a 60% probability of that in December. And then, those 2 rate hikes, which the Fed is talking about right now for 2017, we know the market's betting that those are largely going to melt away as well, continue to put more impetus. But, ultimately, Scott, we've got to see earnings growth, because all this is doing is driving multiple expansion, reach field, corporate debt in the U.S., the highest level it's ever been, and some of those EV/EBITDA numbers also looking stretched. So, my guess would be the panic attacks we've seen more often this year, we're going to see increasing frequency of that into 2017, and at some point in time, that this game of musical chairs is going to stop, and it's going to be painful.
Well, until now, we're seeing gains in stocks. Michael Ingram, thank you so much for joining us.
Pleasure, Scott. All the best.
I'm Scott Gamm, and you're watching The Street.